Good morning, everybody, and welcome back to Beat the Bell, presented by King Capital. Hope you guys are all having an awesome trading week thus far. Let's get straight into it. It's been, or it is going to be, a volatile week. Yesterday was CPI. We got a little bit of a move in the morning. The bulls are still in full control. Hopefully, you all were able to take advantage of that move higher. But we still have plenty in store and plenty to talk about. Let's bring on today's panel, starting with Money Mander. Money Mander, good morning.
Good morning. Good morning. Happy fintwit Super Bowl today. We'll cover FOMC and everything else coming up in a second.
Beautiful. Diamond Trades, good morning.
What's going on, guys? Super excited for today. It should be eventful. I'm excited to dive into it and break it down.
All right, Ramsay Rippers. Morning. Stock Snipa. Good morning. Good quality as always. And last but certainly not least, special guest this morning with us, Matt. Good morning, brother.
So, guys, good morning. Excited to be here.
Dive straight into Fed forecast and economic calendar.
Yeah, let's do it. We'll dive into the economic calendar first. Eventful day today and for the rest of the week. And so we're going to start it off with PPI, which actually just came out. We'll cover that in a little bit. And then FOMC, obviously at 2 o'clock, the interest rate decision will come out. Powell will give his remarks on the economy and the path forward at 2:30. Tomorrow we've got retail sales, that weekly unemployment, and some manufacturing data, and closing out the week Friday with the UMISH preliminary readings for consumer sentiment and inflation expectations. We touched on PPI, which came out a few minutes ago. It actually came in pretty light. So PPI month over month came in about 0.3% versus 0.1% expected. Core PPI year over year came in at 2.8% versus 3.2% expected. PPI is, and regular PPI came in at 1.1% versus 1.5% year over year. So all those came in lower than expected. PPI is a measure of producer prices in the economy, and why that matters is obviously as producer prices go up, they pass those prices off to the consumer, and so it can sort of be a look forward into inflation and what pressures could be on the consumer coming forward. But a pretty light PPI this morning, and so far looking at the markets, kind of a muted reaction. They're probably waiting more so for Jerome Powell and the Fed, but definitely welcome news for bulls with that lighter PPI reading. Let's dive into CPI, which we got yesterday. Consumer Price Index. Headline CPI came down to 4% year over year from its 9.1% peak last year. Core CPI came in at 5.3%, which was right in line with expectations. On a month-over-month basis, headline came in at 0.1%. Core came in at 0.4%. Headline month-over-month did slow down a bit. It came in at 0.4% last month on a month-over-month basis. So seeing that month-over-month increase slow down is always a good thing. Core is still elevated, 0.4% increase on a month-over-month basis for the last 3 readings. So showing that the Fed's preferred measure of inflation is not going to go down easy, right? It's sort of remaining a bit sticky on a month-over-month basis as those year-over-year comps come down with last year's extremely elevated numbers. The CPI numbers are further proof that the Fed's campaign against inflation has had a material impact. The market believes that the numbers increase the probability of the Fed pausing their hiking campaign, with the market pricing in now a 95% chance of unchanged rates at the meeting today. We'll know definitively at 2 o'clock. Interestingly, the probabilities for the July meeting remain unclear, with the market only pricing in a 54% chance of unchanged rates. So that's assuming that the Fed pauses today. The market is giving a 25 basis point cut and a 25 basis point raise, a 38.6% and a 2.7% chance respectively. So assuming that the Fed keeps rates stable today, the market's only pricing in a just above a 50% chance that they're going to do the same in the July meeting, which is a bit weird. We'll have to see how that plays out coming out of today's meeting. Yesterday, the market did, trade broadly higher, welcoming the inflation data. Tech led the way, with the Nasdaq adding 0.8%, SPY up 0.7%, and the Dow up 0.4%. Utilities and industrials both showed strength as well. Best performing sectors in the S&P. A welcome sign for bulls in the face of this historic market run, as many market commentators have been concerned about over the last several weeks. The majority of the stock market gains have really come from those handful of mega cap tech stocks. And so if you're a bull, this is a good thing to see the rally broadening out into some other sectors. When some sectors cool off, some other sectors pick up. That's what you want to see in a healthy uptrend. Today, the market strength will be tested yet again with the FOMC's rate decision and their economic projections at 2 o'clock. Mander, what you got?
Yes, I think given the segment's name, I want to talk Fed first, and I kind of have to agree with the markets here in the pricing of the pause versus a hike. So unfortunately, our call sheet, little bet, they're hero or zero now, so we'll see what we get. But I have to disagree with the Fed's decision to pause, but I'll get to that in a second. First, I kind of want to talk here why the markets are pricing in such a lock of a pause. And going all the way back to March, right? Who remembers that dot plot that I covered here pretty much at every projection meeting? Going back to March was the last Fed projections release. If we look at this dot plot here, the median range for the voting members here was 5.1% is where they saw rates going to in 2023. And currently we're at 500 to 5.25 basis points. So with a 6-month historical average on pauses, that would take us to the end of the year. We're right there where the median of all the voting members saw us going to. Headline inflation gets cut in half down to 4 from 9.1 peak last June that you talked about. All looks great, but if we can pause and go deeper into the numbers here, this is why I'm kind of fearful of the pause at this meeting versus moving forward. Headline fell to 4% year over year, going back to last year's comps that were the highest we saw in over a decade, which you hit on. And this is coming right off a 10% down month in crude. So I know gasoline prices and energy prices were one of the leading drivers in bringing this down. But like you mentioned, core CPI has now been stuck between 5 and 6% year over year for 7 straight months. So realistically, kind of minus that volatile energy downdraw we saw last month, kind of helping headline, there wasn't much progress. And like you mentioned, core CPI, core PCE are really what they're watching here. And so outside of the energy downdraw, it feels like we're kind of glued here, right? Like core CPI month over month has been between 0.4 and 0.45% for 6 straight months. So it's kind of like those core, food, everything else is really unbudged. And so kind of looking outside of the rally in the stock market, obviously the stock market's looking forward. Everyone says like, oh, Powell's going to hate to see stocks are up. That's really not what they're looking at here. But there was in the actual data they look at major signs of economic consumption last month with after 2 down months, retail sales came back in at 0.4% up. Personal spending doubled expectations at 0.8%. ADP and NFP roaring with the labor market strength. So I just kind of fear that we get in the situation that we saw across other central banks where if they pause here and then have to come back and hike, whether it be in July or September, whenever these next meetings coming up are, it really, really discredits what they've been trying to do. So I guess we'll see. I think we get the pause today. Now it's kind of whether that fuels this tailwind to fire up consumption again. People thinking the worst is past us. We're going to get this pivot coming up soon. Spend. They're already spending a lot, right? And so if we get this pause, then a potential pivot, at what point, does the Fed then have to backtrack? Because I think while they've made good progress, it definitely could be unwinded very, very quickly with the strength of the labor market, the strength of the economy that we have right now.
Yeah, I think if you pause with that mindset of like we could just raise later, like just raise them now. I don't see the like why try and get cute with it and try and just raise them now. I talk in my book, but I think realistically it makes sense, right? I don't understand. Well, I guess the contrarian argument would be the wait and see. You don't want to necessarily do more damage to the economy than you have to. If things aren't looking terrible right now, you would pause. And then, if we do get data that sort of that disproves that theory that things are not getting better on the inflation front, then yeah, you do have time to pause going forward. I guess we'll have to see what the committee decides to do today with their decision at 2 o'clock.
I would say I think the Fed kind of sides in your boat as well, though, because every single meeting we've heard for a year straight is that history warns against a premature pause and pivot. So I think if they do pause, they're going to be very sure that the economy is ready for it and they're making the right decision.
Right. I took the bet based off of what Jerome Powell wants. I know that he wants to raise rates. So we'll see. That'll wrap it up for us here at Fed Forecast. Pass it back to Alejandro.
Beautiful, guys. Let's switch gears and talk about the S&P. Let's first take a look at the system. So this has been one of the cleanest uptrends that we've gotten in quite a long time, and it has all been visualized and made very clear by the system. So as you guys know, when the two charts are telling the same story, that's really when the magic happens. What do we mean by that? When we're trading above the 50 SMA on both the 1 hour and 30-minute SPX charts, we have the 30-minute here, we have the 1 hour here. That is when we get the most trend, and that is when the best trades really present themselves. So again, I want to reiterate, not always using the system to necessarily take trades, but I am checking it constantly because I want to understand, along with some other things, such as Rocket Scooter, which we're going to get to in just a bit. But I want to understand, where is the trend in the market? Are the bulls in control? Are the bears in control? Where are my odds better stacked if I'm going long or if I'm going short? And by looking at these two charts, it has been clear as day that going long has been the more favorable approach because of the fact that we have been in a strong uptrend above the 50 SMA on both the 30-minute and 1 hour SPX charts. So as long as that remains intact, and we could likely see a lot of volatility today with FOMC, as we typically do. But as long as the uptrend remains intact, bulls are going to remain in control. And until we break below those 50 SMAs, that is when I would consider there to be a trend change. Now, also very important to note some breakout levels. So just to quickly give you guys a couple of ES levels. 43.67, which was Monday's breakout level, is going to be key. So we have yesterday's support, which is about 43.85, taking a look at my chart here. But Friday's breakout level, whether you're trading SPX, SPY, or ES futures, excuse me, Monday's breakout level, which on ES futures is 43.67. We may see a lot of volatility today, and we could see a move lower. We could see a dip, but as long as that breakout holds, the back test at that level holds, bulls are still going to be largely in control. So understanding where your key levels of support are, understanding that breakouts need to be back tested in order to confirm the breakouts and for bulls to be able to make the move higher. If we sell off, the reason I'm saying this right now is because we're currently trading at 44.20 on the S&P futures. If we sell off to 43.67, it's going to feel like all hell broke loose, and the hysteria on fintwit and wherever else is going to be like the world's coming to an end when the S&P sells 50 points after rallying about 600. But understanding those breakout levels, again, is very, very important. So keep an eye on 43.67. As long as we're trading above there, bulls are in control. Below there, we can chop and start to move back down the levels. All right, so that's what we got with the S&P headed into today. Reminder that we have FOMC today at 2 p.m. So it's really one of those all bets are off situations, understanding that there's going to be a lot of volatility. Trade small, trade light, and manage your risk. All right, let's go into Bet the Bell with Ramsay Rippers. So that's going to do it for the system. I'm going to pass it over now to Ramsay Rippers for Bet the Bell. Good morning.
Good morning, guys.
All right, let's do it. I think we have a tie in the stats. I could be wrong. Alejandro might be up 2 games now. Let's see. Ryan, what do we got? There it is.
Yeah, man.
Slightly,
I mean, top of the
basically
leaderboard.
top.
Makes sense. Makes sense. Let's do it.
Let's go. All right, guys. What do we got today? Green or red? Diamond.
Ooh, I'll go red. Crazy. I'll go red.
Forgot to do a little preface, but indices slightly up, not even like 0.1%. Mander.
Coming off of 4 straight green sessions here in SPY, it's tough for me to take this, but I'm going to say green. I think Powell handles business today.
Hondo.
I'm going green.
Snipe. Matt.
I'm going to have to say green.
All righty, beautiful. Let's move on to question 2. End of week SPX prediction. That's what I want to hear. Where are we closing on SPX? Crazy week of data. CPI, PPI. I believe we have retail sales tomorrow as well at 10, maybe 8:30. Where do we think the market's going? What do we got? I don't need a specific number, but if you want to say something like over 30, 43.50, something like that, give me it. Diamond.
Oh, I will go. This one's kind of hard. I'll go over yesterday's high. I think that even if today's red, I think that we'll rally into the end of the week. So yesterday's high was 43.75. I'll go over 43.75.
Why don't you just say over 4,400? Make it spicy.
That's a bit aggressive.
I'm
comfortable with 43.75.
Honda, what do you got?
Yeah, I mean, I'm going to say over 4,400, no doubt. And I've also been watching very closely this week. Apple, that I said was going to close over 184 or whatever, and that Noah said is going to close like under 177 or something, just like completely ridiculous like that. So I just want to, now that we're midweek, I want to remind everybody to keep an eye on Apple, just so you can kind of watch how hilariously bad Diamond's prediction was.
All right, man. All right. You're talking very early. I am.
Mander and then Matt.
Well, Noah with the safest bet of all time. I mean, we're green in the pre-market, and he's saying that we're going to close over yesterday's highs. Like,
acting like we don't have a whole FOMC today. Like,
Enough
out of you guys. Like, we literally have a Fed today, acting like that's not a thing. Like, stop it.
I'm going to take the higher risk to reward play here. I think we close over 44.25. I'll even one up Alejandro. I think we see a rally at the end of the week.
And Matt, what do you got for us?
So this is like the Price is Right. So I'm going to take your 44.25 and raise you to 44.30 because that's where I think we're going by the end of the week.
44.30. Already, I love it. Snipe, SPX prediction. We got you back by end of week.
Yeah, a hot spot.
All right. Last question. Favorite high beta squeeze potential. We've seen Mander sprinkle some money into SQ, Shopify, names like Affirm, Peloton, really starting to move over the last week and a half, 2 weeks. If you guys had to pick one, what is your favorite in the coming days, weeks, month for a squeeze potential? Diamond.
Ready? This is gonna be my Max Kellerman moment. Remember when Max Kellerman said like fate of the universe on the line?
Of course, Iggy.
Andre Iguodala.
Yeah.
I think the short squeeze candidate that I like the most is AMC. I think AMC over $5 can get a little bit squeezy. Let's see the memes get hot again. Meme summer 2023. I want to see it. They got a trend line they're testing right now on the daily chart, trying to close above it on some high volume. Let's get it going. When AMC's going, GME's going, the market is significantly more fun. So let's see it.
Hondo.
I'm going with one of my favorites, Vuzi, which is an AR smart technology glasses provider. They have been picking up a little bit of steam here off of the Apple product release. So keep an eye on that one. It's ticker VUZI. I think it can really start to go. Currently trading at $5.50.
Alrighty. I like it. I remember that one from years ago.
From a long time ago.
Seniors in college. Mander.
Mine's already out there. It's still Shopify. The weekly bull flag there will jump off the chart at you. So mine's still Shopify. I think this one really gets going.
And Matt.
Well, I'm gonna have to say I'm actually looking at Disney, and I know it traded down on earnings, but using the monthly maps and Rocket Scooter, it actually showed just as of a couple days ago that there's a potential for a short squeeze building up as the bear side is starting to show a lot of weakness and exceeding of positions over the next 2 weeks. So Disney has a really massive gap to fill, which is almost a 10+% move. So I can see that one moving pretty good for the next month or so.
The chart looks good on Disney as well. The daily chart.
All righty, beautiful. Appreciate it. And Snipe. Muted.
I too want to buy Disney like Matt will.
All right, that's going to do it for Bet the Bell. We're going to pass it back to Hondo here. I believe we're going to Matt next.
All right, rocket scooter time. Matt, what do you got for us?
So let me tell you something. This short squeeze that we've been seeing in the market has been fueled by additional waves of actual bullishness. You know, Rocket Scooter has a tool called Monthly Map. It's one of my favorite tools that we have. I'm presenting my screen if you guys can see it. There is this particular rally that we've been seeing in this bear market, right? Has been something that we have shown on our platform. The data has been here since October of last year, and it is still here going until July of last week of July. What this actually is showing you is bullish positioning against dealers and bearish positioning against dealers. That's what one of our main bread and butter calculations are here. And if you see the bull side's getting stronger, this is the SPY, and the bear side is getting weaker over the next month. This is just the SPY alone. This is showing still rapid squeeze potential that's not going to inflect until middle of the summer. And so when you're looking at this kind of positional data, it doesn't matter what the fundamentals are. It doesn't matter what anything is. This is the people's actual positions. Their motivations are their motivations. And that bull side is strong and people are still willing to buy. You know, you can take your best guess. But to me, with a stock market that looks like this, I mean, it's just better to plant money here than sit there and let it burn due to inflation. So in the high inflationary environment with the Fed pausing, you have to think that Wall Street would believe that the aggressiveness against rate hikes would kind of slow down and then inflation could kind of creep up, and the stock market is a great place to just place your money temporarily. And you're seeing that. Here's the NASDAQ, and it's going to show you how much stronger that is. When this bull side, the bottom of this dark gray slopes down, that is strengthening bull side, and NASDAQ is bullish through September. So the squeeze potential on NASDAQ from this many months is enough to double top this entire market, even despite massive bearish fundamentals, because the bear side, which is this lighter gray, is weakening and has no inflection point in July. So it really shows the strength of how far tech is squeezing this market, and it's not going to stop anytime soon. I know about 3 months ago, I was saying about 4,600 S&P was very likely top out, and it's looking like it's going there right now. There's a lot of potential in this market to continue to go, but it's not, to me, a recipe for bullish higher highs and maybe the entire S&P. But while tech just continues to squeeze, it's going to stop when it stops. There are people that have been surprised in this market, and they're just sitting there upside down in these short positions and just getting squeezed harder every single day. What I love about this positional data is that it doesn't lie, and everything you look at, as far as data goes, it supports what you're seeing in the market. And I'm going to pull up one more screen. The commitment of traders, a quick little blurb on this report. This is the TFF report and the commitment of traders for the S&P E-mini contract. This is futures, and this futures data is splitting all active positions in S&P futures into 4 categories: market makers, asset managers, hedge funds, and then other reportables, which are like smaller banks. So if you look at this, a key takeaway why this market is not going to crash is this red line right here. If you see where my mouse is, this is about 100,000 and something contracts of the net long. The market makers are still in a net long position if you add up all their positions. In the history of this report, never when this red line has been above 0 has this consolidated market crashed at all whatsoever. Anytime the market makers hold a net long position, the market continues to go higher until they're short. It doesn't collapse like the crash in 2008 until they get out of their short position first. And we are still sitting here with this net long position as people have been trying to sell this recession and they're stuck. So the dealers don't drop the bid on themselves when they hold the bag. And that is a key takeaway of what we said. And I wrote this thesis back in October on how if we see that happening, you're not going to see this market sell off until they can wiggle out of this position. And this green line is the asset managers, just your 401ks and mutual funds and all these buyers of stock. And the long is continuing to get longer. There's actual buyers since October of last year. When there are buyers and Fed holds the bag, the market goes nowhere but up. And it's not a surprise. This is a positional shift as people that have been betting against the stock market for years, right? This is the net short. The hedge funds are getting squeezed. And right now they're as short as they've ever been. Even right here, they're shorting as it's going up, but until the dealers get out of the bag, it's not going to fall. 20 years of this report, never done it once.
Most interesting, going back to the monthly maps, that big money is bullish at lower prices as well. So there's still the possibility that we see a pullback,
100%. And you
which
can see
would
right here.
be a great opportunity based on the monthly maps that we're looking at. And I
100%.
think that that's what a lot of people don't understand, and a lot of the hysteria that we'll see when the market finally does pull back, and everybody is kind of trying to call top because of the insane run that we've seen thus far this year. But the pullback is going to come, and as long as this positional data remains as such, with market makers willing to be bullish at lower prices, I think that's the most important takeaway, that positionally they're still very bullish at lower prices.
That's exactly right. And you could see that whenever there is a space between bullishness, so bullish up here and bearish down here, whenever there's a space, that's the actual volatility. So volatility tends to come in waves, right? And you can almost project it like there's waves up with some volatility, waves up with some volatility. There's going to be dips along the way. So every time the market gets volatile, it can be leading into events like other FOMCs or CPIs or GDP data. Important economic factors as people are going to take profits. And likely when it comes to S&P and NASDAQ, for instance, people are just taking profits and rolling into the Russell. We've been seeing that a lot. So the idea is right now to identify where the rally is going to be. Money's going to flux into the stock market until those S&P dealers are in a net short. And so where are they going to flux into? You just have to see how it works. So as the S&P selling off, those weeks you might see the Russell rally. To see everything turning around and selling off is something I don't think we're going to see for a while, and at least through the fall. And so I think you're 100% right. When those pullbacks happen, the bears are going to be like screaming, "This is it! I told you so." But the positional data is what it is. You cannot argue. These are actual options that expire along this path. This is people still willing to be bullish at 390 SPY at the end of July. So the market could dip this far and hold, and then come, into the summer, it's still bullish, even with a dip like that. There are people can't wait to get into this market, exactly like you had said. And this positional data shows that. It's a simple analyzing, and Rocket Security can put any stock in here and do the same thing. That's what's great about it. It's just when that bull side goes lower, people are willing to buy the dip at a lower spot. Market can do this, and it's still going to be bullish. And that's what I love about looking at this data, because the data doesn't lie. And this is the sum of everybody's information, beliefs, fundamentals, inside data, anything, any reason people have a position sitting there at that point in time is something that we aim to exploit and look for as far as getting us real market sentiment, despite what we think would happen with the fundamentals.
Awesome, Matt. Thank you. Always sharing valuable information. Really appreciate you coming on the show. That's going to do it for this morning's episode of Beat the Bell, guys. Appreciate everybody that tuned in. Hopefully you were able to find value. As you guys know, we'll be trading live all day in the Kane Capital Discord. You can go to kane-capital.com to trade with us. We do have a 7-day free trial that is currently live. Let's get to it, guys. Another big trading day in store. Ready to go. Hope you guys are as well. We'll be back on Friday morning, 8:30 a.m. Eastern time, for the final episode of the week. We will see you guys then. Have a great rest of your day, everybody. And trade well, trade smart, manage risk.